There's a secret that every billionaire knows, but they'll never tell you. Because if they did, they'd lose their biggest advantage. You see, most people think the hardest part about money is making it. But that's the lie that keeps the poor poor. The truth? Making money is easy compared to keeping it. And here's the paradox that will blow your mind. The moment you start getting rich, the system is designed to make you poor again. I'm going to show you the 9 psychological traps that destroy 90% of new millionaires within 5 years, and the counterintuitive strategies the ultra-wealthy use to escape them. Because by the end of this video, you'll understand why. Your biggest enemy isn't poverty, it's prosperity. Let's dive in. The millionaire's curse. Here's something that will shock you. 73% of lottery winners go broke within 5 years. Athletes who make millions, 78% are bankrupt within 2 years of retirement. Entrepreneurs who sell their companies for 8 figures, most lose it all trying to recreate their success. This isn't bad luck. This isn't poor planning. This is the millionaire's curse, and it's systematic. But here's what's really crazy. The same psychological traps that destroy lottery winners are the exact same ones destroying you right now. Whether you're making $50,000 or $5 million. Trap number 1. The success delusion. The moment you taste success, your brain plays a trick on you. It whispers, "You figured it out. You're special. You can't lose." Psychologists call this the hot hand fallacy. Your wins weren't just skill, they were skill plus timing plus luck. But success makes you forget about timing and luck. Take Adam Newman from WeWork. Early success made him believe he was invincible. He thought he could do no wrong. $47 billion company to nearly worthless in months. Or look at the dot-com millionaires of 2000. They thought the rules didn't apply to them. They leveraged their paper wealth right into bankruptcy. Success isn't just intoxicating. It's literally addictive. Studies show that winning triggers the same neural pathways as cocaine. Your brain craves bigger wins, bigger risks, bigger validation. And that's when you start making million-dollar mistakes. Trap number 2. Lifestyle inflation. Here's a question that will haunt you. What's the difference between making $100,000 and $1 million if you spend it all? The answer is 0. But your brain doesn't see it that way. It sees the million and thinks, now I can afford anything. This is where most people destroy themselves. They think lifestyle inflation is about buying Lamborghinis. But it's more subtle than that. It's the $200 dinners that become normal. It's business class flights because time is money. It's the $50,000 kitchen renovation because we deserve it. Each decision seems rational in isolation. But together, they're financial suicide. I know a guy who made $2.3 million selling his software company. Within 18 months, he was back to his corporate job. How? $400,000 house became $800,000 house. 2 cars became 4 cars. $3,000 monthly expenses became $15,000 monthly expenses. He didn't buy crazy stuff. He just normalized expensive. The wealthy understand something crucial. Your lifestyle should lag your income by at least 2 to 3 years. When Jeff Bezos became a billionaire, he still drove his Honda Accord. Warren Buffett still lives in the house he bought in 1958. They know the secret. Every dollar you don't spend is a soldier in your wealth army. But lifestyle inflation is nothing compared to trap number 3. The one that's destroyed more millionaires than the 2008 crash, COVID, and every recession combined. And you're probably falling into it right now. The investment trap. Trap number 3. The sophistication trap. The moment you get some money, everyone wants to make you sophisticated. Private banking calls you. Hedge funds send you prospectuses. Your accountant suggests tax optimization strategies. Suddenly, your simple portfolio of ETFs feels amateur. Rich people don't buy index funds, they whisper. You need alternative investments, private equity, real estate syndications, structured products, and you fall for it. Because here's the psychological kicker. Complex investments make you feel smarter, even when they make you poorer. Yale's endowment, managed by the smartest people in finance, returned 6.8% annually over the last 20 years. Want to know what beat them? A simple 60-40 portfolio of stocks and bonds, 7.2% annually. The most sophisticated investors got beaten by the most basic strategy. But here's why this happens. Complexity is profitable for everyone except you. That hedge fund charging 2% management plus 20% performance fees? They win even when you lose. That private equity deal with 5-year lockups? They get paid regardless of returns. The financial industry makes more money when your investments are complex, so they convince you that complex equals superior. The Charlie Munger principle. Charlie Munger once said, "I have never succeeded in making money in a sophisticated investment that I didn't understand." Think about that. One of the greatest investors ever avoided anything he couldn't explain simply. The ultra-wealthy get this. They keep their core wealth in boring, predictable assets. Then they play with 5 to 10% on sophisticated stuff. But most millionaires do the opposite. They put their core wealth at risk chasing sophistication. Remember Bernie Madoff's Ponzi scheme? His victims weren't stupid. They were successful doctors, lawyers, business owners. They got seduced by sophisticated returns that regular people couldn't access. The sophistication wasn't real, but the losses were. Trap number 4. The diversification delusion. Here's another lie they tell you. Diversification is protection against ignorance. But what they don't tell you is this. Over-diversification is protection against wealth. I see this constantly. People with 47 different stocks, 12 ETFs that overlap, REITs, commodities, international funds, emerging markets, sector rotations. They think they're being smart. Actually, they're being neurotic. Warren Buffett says, diversification is protection against ignorance. It makes little sense if you know what you are doing. But here's the twist. Most people don't know what they're doing. So they should diversify. But they diversify wrong. They buy 50 things they don't understand, instead of 5 to 10 things they understand completely. The focus principle. The wealthiest families concentrate their wealth. The Waltons, Walmart stock. The Bezos family, Amazon stock. The Gates family, Microsoft, then diversified. Concentration builds wealth. Diversification preserves it. The key is knowing which phase you're in. Building wealth phase. Focus on 3 to 5 high-conviction investments. Preserving wealth phase. Diversify into 10 to 15 uncorrelated assets. Most people diversify when they should concentrate, and concentrate when they should diversify. Trap number 5, the performance-chasing trap. 2021. Everyone's buying crypto and meme stocks. 2022. Everyone's buying value stocks and bonds. 2023. Everyone's buying AI stocks. Notice the pattern. People always buy what just went up. It's called recency bias, and it's devastating. Your brain assumes recent trends will continue forever. If tech stocks went up 30% last year, they'll do it again. If crypto crashed 70%, it's dead forever. But markets don't work that way. They're cyclical, mean reverting, unpredictable short-term. The wealthy understand this. They sell what everyone wants to buy. They buy what everyone wants to sell. In March 2020, when COVID hit, everyone was selling everything. Stock market down 35%. People were convinced it was the end. What did the smart money do? Berkshire Hathaway bought $25 billion in stocks. The ultra-wealthy loaded up on real estate. Private equity firms raised record amounts of capital. Why? Because they knew something you didn't. Panics create the best buying opportunities. 18 months later, those assets had doubled. But most people did the opposite. They sold at the bottom and bought back at the top. This is why the rich get richer. Not because they're smarter, because they're contrarian. Speaking of contrarian, The next trap is the most dangerous one of all, because it doesn't just destroy your money, it destroys your mind. The psychology of wealth. Trap number 6. The status trap. Money changes how people see you, but more importantly, it changes how you see yourself. Suddenly, you're successful. You're an investor. You have influence, and that's when the vultures circle. Every entrepreneur I know has this story. The moment they got some money, everyone became their friend. Family members with business opportunities, old college friends with sure-thing investments, strangers wanting to pick your brain. But here's what's really happening. You're not gaining friends. You're gaining predators. And the scary part? You start to like it. Humans are status-seeking animals. We crave validation more than oxygen. And money buys validation like nothing else. So you start saying yes to things that stroke your ego. Angel investing in startups because you're smart. Lending money to friends because you're generous. Joining exclusive clubs because you're successful. Each decision feels good in the moment. But collectively, they're bleeding you dry. The Buffett filter. Warren Buffett has a simple rule for this. Learn to say no to the good opportunities so you can say yes to the great ones. But here's the part he doesn't tell you. Saying no to people is emotionally brutal. Especially when they make it personal. I thought we were friends. You've changed since you got money. Just this once. The wealthy learn to be comfortable being the bad guy. Because protecting your wealth matters more than protecting feelings. Trap number 7. The expertise illusion. Success in one area makes you think you're smart in all areas. Made money in real estate? Now you're a stock market genius. Built a successful business? Now you can day trade Forex. Sold your company? Now you're qualified to manage a hedge fund. This is called domain confusion, and it's expensive. I know a guy who built a $50 million construction company. Brilliant at construction. Absolute master. But then he decided he was also a brilliant investor. Started day trading with $5 million. Lost $3 million in 18 months. Why? Construction success has zero correlation with trading success, but his brain couldn't separate them. The circle of competence. Warren Buffett and Charlie Munger talk about staying within your circle of competence. Know what you know. Know what you don't know. And never confuse the two. The wealthy understand this deeply. They stick to what they understand. They hire experts for everything else. But most new millionaires think money equals expertise. So they venture outside their circle, right into expensive mistakes. Trap number 8. The leverage trap. Nothing destroys wealth faster than leverage at the wrong time. But here's the paradox. Leverage is how most people got rich in the first place. Real estate leverage, business leverage, even stock leverage through options. So when it works, you think you're invincible. You start using more leverage in more places at higher multiples. 2006 to 2007, real estate investors were geniuses. They buy properties with 5% down. Prices went up 20% per year. They were making 400% returns on their money. I'm so smart, they thought. So they bought more properties. Higher leverage. Riskier deals. 2008 happened. Prices dropped 30%. Suddenly, 400% returns became 100% losses. Leverage amplifies everything. Your gains and your losses. The asymmetric risk principle. Here's what the wealthy understand about leverage. You can only lose 100% of your money once, but you can make unlimited money if you don't lose it. So they use leverage conservatively. They assume the worst-case scenario. They stress-test their portfolios. Most people do the opposite. They use maximum leverage. They assume best-case scenarios. They optimize for maximum gains instead of maximum survival. And that's how millionaires become broke. But there's one more trap. The deadliest one. And it's not about money at all. The ultimate wealth destroyer. Trap number 9. The happiness trap. Here's the cruelest paradox of wealth. The things that make you rich don't make you happy. And the things that make you happy often make you poor. Studies show that beyond $75,000 annually, more money doesn't increase happiness. But what does decrease happiness? Constantly worrying about money, constantly optimizing every financial decision, constantly comparing yourself to richer people. The hedonic treadmill. Psychologists have a term, hedonic adaptation. It means you get used to any level of wealth. The millionaire looks at the billionaire and feels poor. The billionaire looks at Jeff Bezos and feels poor. There's always someone with more, and your brain will find them. This is why lottery winners aren't happier after a year. This is why celebrities struggle with depression. This is why having it all never feels like enough. The money happiness paradox. Here's what I've observed. The people best at making money are often worst at enjoying it. They're always optimizing, always looking for the next opportunity, always feeling like they should be doing more. Sound familiar? The wealthy learn to separate two things: wealth building, systematic, unemotional, boring; life enjoyment, spontaneous, emotional, fulfilling. Most people mix them together. They tie their self-worth to their net worth. They judge every expense against potential returns. They optimize the joy out of everything. The richest person I know drives a 15-year-old Toyota, lives in a modest house, wears the same 3 outfits, but he travels to 20+ countries per year, has incredible experiences, spends freely on things that matter to him. He optimized ruthlessly in some areas, so he could spend freely in others. The wealth paradox solution. Here's the secret the ultra-wealthy know. True wealth isn't about having the most money. It's about having enough money to ignore money. When you have enough saved and invested, you stop checking your portfolio daily. You stop optimizing every purchase. You stop thinking about money constantly. And that's when you start actually living. So how do you avoid these traps? How do you get rich and stay sane? I'm going to give you the exact system the ultra-wealthy use. The ultra-wealthy system. The 4-bucket system. Every ultra-wealthy family uses some version of this system. 4 distinct buckets with different purposes. Bucket 1, security. 40% of net worth. This bucket's job is simple. Never lose money. High-grade bonds, CDs, money market accounts. This bucket lets you sleep at night. It's boring. It's supposed to be. Bucket 2, growth. 40% of net worth. This is your wealth-building engine. Index funds, real estate, business investments. Long-term focused, diversified, systematic. This bucket works while you sleep. Bucket 3, speculation. 10% of net worth. This is your play money. Individual stocks, crypto, startups, options. High risk, high reward. This bucket satisfies your gambling instincts safely. Bucket 4, lifestyle. 10% of net worth. This buys your happiness. Experiences, hobbies, giving. Guilt-free spending on what matters to you. This bucket reminds you why you're building wealth. Notice something important. Only 10% goes to speculation. Most people put 50 to 80% in speculation, then wonder why they lose money. The wealthy get their thrills with 10% and build real wealth with the other 90%. Here's how to make this work. Automate everything. Automatic transfers to each bucket. Automatic investments within each bucket. Automatic rebalancing quarterly. Set clear rules. Never move money between buckets. Never break the percentages. Review annually, adjust gradually. Ignore the noise. Don't check portfolios daily. Don't react to market news. Don't optimize endlessly. The wealth protection protocols. The ultra-wealthy also follow strict protocols. Protocol 1, the 48-hour rule: never make financial decisions emotionally. Wait 48 hours before any major decision. Most bad decisions happen impulsively. Protocol 2, the expertise test: before investing in anything, ask, Can I explain this investment to my grandmother? If not, don't invest. Protocol 3, the friend test. Before lending money or investing with friends, am I comfortable losing this relationship? If not, say no. Protocol 4, the lifestyle lag. Your lifestyle should always lag your income. Got a raise? Wait 6 months before increasing spending. Sold a business? Wait 2 years before lifestyle changes. The mindset shift. But here's the truth. All the systems in the world won't save you without the right mindset. The ultra-wealthy think differently about money. Not just what to do with it, but what it represents. Money is a tool, not a scorecard. Poor people see money as scarce. Middle-class people see money as security. Rich people see money as a tool for freedom. Ultra-wealthy people see money as a responsibility. They're not trying to impress anyone. They're not keeping score. They're building something that lasts beyond them. The generational mindset. Here's the ultimate wealth secret. True wealth is measured in generations, not years. When you think generationally, you stop making short-term decisions. You stop chasing quick wins. You start building systems that compound over decades. You start protecting what you've built. The paradox resolution. Remember where we started. The paradox that getting rich makes you poor? Here's how you resolve it. Get rich slowly. Stay rich permanently. Most people try to get rich quickly. They take huge risks, make emotional decisions, chase performance. They might succeed temporarily, but they always give it back. The ultra-wealthy do the opposite. They get rich boringly. Consistent contributions, diversified portfolios, automated systems, long-term thinking. It's not exciting. It's not sexy, but it works. You have a choice right now. You can chase the next hot investment. You can try to time the market. You can look for shortcuts and hacks. Or you can start building real, lasting wealth. The boring way, the systematic way, the way that actually works. The compound effect. Because here's what most people don't understand. Time is your greatest asset. Not intelligence, not luck, not timing. Time. The person who starts investing $500 per month at 25 will have more wealth than the person who starts investing $2,000 per month at 45. Not because they're smarter, because they started earlier. Getting rich isn't about being perfect. It's about being consistent. It's not about making the best decisions. It's about avoiding the worst ones. It's not about maximizing every opportunity. It's about not losing what you've already built. The millionaire's paradox is real. Getting rich can make you poor, but only if you let it. Only if you fall into the traps. Only if you forget that wealth is a marathon, not a sprint. You now know what destroys millionaires. More importantly, you know how to avoid it. The question isn't whether you can get rich. The question is whether you can stay rich. The final truth. Getting rich isn't about being perfect. It's about being consistent. It's not about making the best decisions. It's about avoiding the worst ones. It's not about maximizing every opportunity. It's about not losing what you've already built. The millionaire's paradox is real. Getting rich can make you poor, but only if you let it. Only if you fall into the traps. Only if you forget that wealth is a marathon, not a sprint. You now know what destroys millionaires. More importantly, you know how to avoid it. The question isn't whether you can get rich. The question is whether you can stay rich. And that's entirely up to you. If this opened your eyes to how wealth really works, if you're ready to think like the ultra-wealthy instead of chasing get-rich-quick schemes, then you need to be part of the Rich Mind Lab community. Hit subscribe and turn on notifications, because every week, I break down the real strategies that build lasting wealth. Not the flashy stuff that sells courses, the boring stuff that actually works. And if this video changed how you think about money, share it with someone who needs to hear this. Because true wealth isn't just about what you accumulate. It's about what you protect, what you preserve, what you pass on. This is the Rich Mind Lab. where we don't just get rich, we stay rich. And that makes all the difference.